We're beginning in the discussion about leases, and we are on slide 29. We're also covering the learning objectives, which begin with number 5 and end with number 8. I'd like to go over those with you a moment. The first thing we're going to cover in this PowerPoint is a discussion of what an operating lease is and why we would record an operating lease versus a finance lease. The second objective is a shortcut method and why it is acceptable and when it is acceptable. You understand in all we're doing, we talk about theory. There is a theory to accounting. It's very important you understand accounting theory because when you're out there working, a lot of your situations and transactions don't fit neatly into an understanding of, well, I do it this way. You will find many different transactions. You need to know how to handle them based on theory. There are lease uncertainties, and this is quite common, that there are a lot of clauses in contracts, and what do you do if there's a clause in a contract? It's not straightforward. How is it handled? And I want you in that area to understand what you are to do and not so much to be able to work through a problem with uncertainties. There's also a concept called reassessment. And this is when things change so dramatically that the new contract, that you almost look at it and say, I have a new contract, because it changed so much from what it was. In contract law, you can make amendments to your contract, and that's when the parties agree to change something in the original contract. Sometimes these contracts get out of hand and it really looks like a whole new contract. So what should you do? And again, it's substance over form. Look at it. Is it still a financing lease, or now is it an operating lease? What do you do if that changes? And then lastly, and this is the one in 8, Learning Objective 8, I do expect you to understand how to make these calculations. And that is when you have what I call the bargain purchase option. The new lease rules say just a purchase option that is expected to be fulfilled. They don't say a bargain purchase option anymore, but I like the BPO concept, so I still use it. And then residual value. It sounds harder than it is. Technically, a BPO or a residual value that is guaranteed is handled exactly the same way. The only difference being a little bit of a difference in the journal entry. The calculations are all the same. Okay, so let's talk about an operating lease. An operating lease is when someone rents. So you have a person that's renting out an asset, and you have someone that is the recipient of that, or who is renting it. And these two parties, you commonly saw this in the abbreviated version of financial accounting. You saw that as a rent expense or rent revenue concept. And it is no different here, except that if there is a contract between the parties, then we have to see if there is an obligation. If there is an obligation, we know that means you have a liability, right? Because we have to go back again to the theory behind the whole thing. And if there's a contract which is signed, then the party who signs the contract has to record a liability. Okay? Because there is an obligation, the contract in a contract which exists, the party that is leasing it has an obligation. Therefore, we have to record a liability. If there's no contract between the parties, there's nothing binding between the parties, you don't have the obligation, there's no obligation, therefore there's no liability. Now, in this chapter, when we're talking about leases, we are going to assume there is an obligation or a contract behind them. So an operating lease it is something that is not handled the same way by both the parties. And this is a very difficult thing for students to understand. So even though when we look at our criteria, we say it does not meet the criteria for a finance lease, we are still going to say that there is a liability that the lessee must record. Now, does the owner of the property, the one that's leasing it out, get to record a lease receivable? And the answer to that is no. So you have one party, the one who is agreeing to make payments in the future, that party has to record the liability as a lease payable, but the one who is renting it out does not get to record a lease receivable. Also, the party that is leasing it out does not take the equipment off their books. Or if it's in the case of inventory that's being leased out, they don't get to take the inventory off their books and record the sale. Instead, they just record rent revenue as it passes. Now, since we are under accrual basis of accounting, if you're at the end of a time period and you are the one that's renting out the equipment, you are going to record a rent receivable. This is not a lease receivable. This is a temporary situation that is created by accrual accounting. So there's a difference there. This is a very interesting area. It is what I call reciprocity. It's kind of a violation of reciprocity because generally when you see one party having a lease receivable, you have the other party with a lease payable. And when you have one with interest revenue, you have another with interest expense. And it's done the same way. That's what we do under financing leases. When you get into operating leases, you don't have that reciprocity. It might take you a little time to work through this and to understand it. I suggest you spend some time in your smart book and really get into this and delve into it. Then the liability that shows up on the lessee's accounts, that liability is going to be excluded from all debt ratios. So your debt to asset ratio is going to exclude these liabilities. It's still a liability, and when you do your journal entries for operating leases, there's an exception, of course, coming up. But when you do your journal entries for operating leases and you are the one that is leasing the equipment, in general, it looks very much the same as under a financing. So the lessee is going to record the right of use asset and a lease payable, and it's going to be the same basic journal entry as you did under what I'm calling a capital or a finance lease. But, there's a but there, you see. The lease payable is considered a non-debt liability, and therefore when the debt to asset ratios are calculated, it's excluded from the list of liabilities in the debt to asset calculation. Here is a similar problem we've had in our first set of PowerPoints. I really hope you spent some time on this and really studied it in our first PowerPoints here, because it's the same problem coming up again, except what they did was change it to 4 years, the lease term, with a useful life of 6 years. And when they work through the calculation, you need to be able to do this, to work through those criteria. On your exam, I'll give you a problem. You're going to have to work through the criteria, and you're going to have to tell me, is this a capital or finance lease, or it is an operating lease, by working through the criteria. Here they changed something in it, so when you do the work and you work through the criteria, it comes up being an operating lease. So it does not meet any of those for a finance lease. It's an operating lease. Well, this thing here really looks quite the same as if it had been a financing lease, because the lessee is going to put a debit in there for this right to use asset and going to create a lease payable. As we just said a moment ago, though, if the financials were done at this point, we would not use it in any sort of a calculation to create our ratio analysis. We would, as a liability and debt, it would show up as a liability on the financials, just as if it had been in a financing lease, but when we do the calculations and ratios, it's excluded. Otherwise, looks very similar. The right of use asset and the payable are based on present value calculations. However, the lessor does not get to record a receivable. So here is an example of a lack of reciprocity, because one party, the lessee, has having to record a liability, but the lessor does not get to record a receivable asset. And what they're saying, you don't get, the lessor does not get to derecognize an asset. All they're saying is you don't get to take an asset off the books. If it was inventory, they don't get to take the inventory off the books. If it's equipment, they don't get to take the equipment off the books. If they don't take a fixed asset off the books and they're the lessor, it means they are going to continue to depreciate it if it's depreciable. So, they could have land, and they could have land, for example, being leased out. In all the journal entries we've been talking about, even though we've been using equipment, it could be land. If land is leased out and it's the lessor, of course, there's no depreciation ever taken on land. You know that. So here we have a situation where the lessor is only going to then wait until a time has passed, and if the lease agreement shows at the financial statement period of time that there should be lease revenue accrued, of course they're going to accrue that lease revenue, all right, at that time period. But they're not going to put on their books a lease receivable and take off that lease receivable over a long period of time. They're just going to accrue some lease amount whenever it's time to do the financial statements, like you always do, whether it's prepaid, whether it's all kinds of expenses. You do deferral and accrual adjusting journal entries. That's what I'm talking about. You don't put a lease receivable on the books. Well, you've got this in front of you for the lessee. What does it tell you? Well, if you got something like this, you're going to know that you're going to have to take that lease payable off the books, and since it's using present value calculations, some of you are thinking ahead, I hope, and you're knowing now that you're going to have to do an amortization schedule with it. So if you have an operating lease and you're a lessee, you still have to do an amortization schedule, and you're going to fall back on and use what we learned in our first set of PowerPoints about recording the journal entries with the interest expense. You're going to have to do the same basic journal entries. There's a second journal entry that gets done with an operating lease, though, and we'll get into that. This is that. The first journal entry is just something that's very basic up here, and this journal entry is the journal entry which is coming strictly from an amortization table. You learned that in your first set of PowerPoints on leases. However, the exception here is when you have a lessee and the lessee is operating under a operating lease, the total amount of what we call rent expense is going to be interest expense plus the right of use amortization. Those two things need to equal the payment amount. So to get it to be equal, you do a second journal entry. So you create your amortization table, you do your first journal entry like you always have been doing it, and now you do a second one which adjusts your rent expense, and rent expense here is again defined as interest expense plus amortization expense. You adjust it so that the total of those two is equal to the payment. So you can look at this and you can see how they've done the second journal entry so that you can add the interest expense amount here to the amortization expense, and when you add those two, and this is rent expense, it's equal to 100,000. So it's the change in accounting, going from the old way in which we did leases to this, what I'm calling a new way, because it's really kind of a radical change for us in accounting, creates a financial statement so that when you're under an operating lease and you're the lessee, your rent expense is always equal to the payment amount. Isn't that interesting? Still though, unfortunately, you have to go through and create the amortization tables. You need to learn how to do those amortization tables and get very comfortable with them, because you have to work through an amortization table. You have to create an amortization table and pull the numbers from that amortization table when you take your exam. So the second one, if this was a financing or a lease, a finance lease, we would, in the second journal entry, when we record our amortization expense, we would amortize it using a straight line basis. We would divide the 75,130, we would divide the total amount of the lease asset. In this, it's 348,685, isn't it? We would divide that total amount of that right of use asset equally between the time periods, and our amortization expense in every single time period would be the same. Under an operating lease, we're going to adjust it. So it's not the same. How do you get to the amount? The amount is subtracting out interest expense from the payment. That's the amount of amortization expense. Now, the first payment, recall, if it is a due situation where they're making a payment up front, all of it goes to the lease payable. So just recall this. I get a lot of wrong answers on exams, wrong answers on homework, because students forget that the first payment, if it's a down payment situation where they make the first payment at the beginning of the lease, you can't put interest on that amount. So you pay the amount down and you need to subtract that first payment, 100,000, before you do calculate your interest expense. It's true under operating leases. This is also true on under the financing lease or capital lease. Those terms are interchangeable. So this is a good exercise for you to start working through this. Now, if I say, and I ask you, what is the amount of the interest expense for the first year? And I'm going to show you this here. The interest expense for the first year, this 12/31/18 is really the same as January 1st, 2019. And the amount of interest for the first year, you need to use this number, because in technicality, I suppose this number here should be 1/1/2019, this date here, But the difference between 12/31/2018 and January 1st, 2019 is 1 day. That is really immaterial. If I ask you interest expense for the first year, what are you going to say? I want you to say this. Don't get hung up on the fact that 12/31/2018 is not 1/01/2019, because under the accrual method of accounting, we would have accrued this as interest expense, right? Okay, so you see, this you need to be sure and understand all of this. This is really from our first slides, but just remember the first payment, it does not, since it's done at this time, at the beginning, there's no passage of time. If there's no passage of time, you can't calculate interest on a balance because the balance is not outstanding for any period of time. The only amount that's outstanding for a period of time is this amount here because this is the same date. Be sure you get that. You go through and you build a table just like you've always built a table, and hopefully you come up with a 0 here. You may be a little off, and that's okay because of, again, our present value tables. And when you go through here, you see the total amount of interest is here. The total amount of the payments is here. And so you're going to see that the difference between this and this, if this is the interest expense, then you're also going to see that the payments is this. The other part of the interest, the other part of the rent expense then needs to be such that the total amount of payments over the period of time is equal to your rent expense. So you can see what's happening here. This column here, which is the decrease in balances, is also the amount that you need to show as depreciation. I'm going to call it loosely that. It's amortization of the right of use asset. This is 348,685, happens to be also what you recorded the right of use asset for in the beginning. So it's really a rather clever way of coming up with all this. I think the person that did it is a genius. But when you look at this, the decrease in this is also the total amount of your right of use amortization. This is only done for the lessee. This is not the lessor. The lessor does not get to record a lease receivable. Now, this also, I would say, is conservatism, the concept of conservatism. Because what we are saying here is even though that other party has a contract and a contract says that they are going to receive a total of $400,000 in payments, they don't get to record the receivable. However, this party, the party that has a contract that says that they are going to have to pay, well, guess what? That party has to record the liability. So what you have happening then is a lack of reciprocity, and it's really forcing the person that owes to record a liability, but not permitting the other party to record the receivable. It's a lack of reciprocity, and it's also conservatism. So if we went through this, and we went through it and we calculated this, every time we do our calculation and do our journal entry off of the amortization table, because it's an operating lease, you have to do an adjustment. And the adjustment that you do is not you would normally do it as an amortization of the right of use asset. You'd probably have it programmed in there where you would just do this amortization of your right of use asset on a straight line basis. You don't get to do that now. Now you have to look up there and say, what is my reduction in the lease liability? It's 82645. Well, that is going to be the amount which you need to show as your amortization expense. So you do this journal entry instead of straight line. That's really what we're doing. Now they say up here, I think sometimes their textbook terminology just tries to confuse you. they are going to say that they use the term straight line lease payment, or they're going to say straight line rental expense or straight line lease expense or something like that. All they're saying is that the total amount of those two expenses which you have before you, this and this, need to add up to that. That's all we're saying. And that's always the same. So your total lease expense for every single period of time is equal to the payments made for that period of time. Interesting, isn't it? So in a finance lease, the amortization reflects the right to use the asset and the financing of the right to use that, and that is the financing showing up in interest expense. And in an operating lease, what you're trying to do is get the total lease expense to mirror what it would have been if it was a straight line or a rental. If you were actually having a rental expense, it is equal to the payments. So we used to not have to do the amortization schedules at all for an operating lease. We just did, we recorded it as a rent expense. There was no present value calculations done if it was operating lease. These new ones, they say, hey, that is just not right. And again, it is not right because you have an obligation. If you have an obligation, then you have a liability. If you have a long-term liability, then you have to do present value calculations. And you have to record the liability. So frankly, I think this change is theoretically better. It is also better when it comes to being truthful, or we say it's representational truthfulness in our financial statements, because there is a contract. So if there is a contract, how could we not record a liability? That goes back to what you learned in your very first module of the semester. Here we have an operating lease, and on these it's best if I just show you how to calculate it in this, even though it is an operating lease, and they tell you in the problem there's an operating lease, so you don't have to go through the checklist. You know that the amount which is recorded there, the present value of the lease payments is going to be $80,000. If you have that, you still got to do your amortization table. You work through your amortization table, you figure out what interest is, and you know that the two of them have to add up to your payment. So the two amounts add up to the payment, so your amortization has to be the difference between the $12,000 payment and the interest which you've calculated off of that amortization schedule. Now, the comparison of this, though, you see you're building the amortization table, and it looks exactly the same thing, whether you're using a finance or operating lease, except when you do your journal entry for calculating the amortization of a right-of-use asset under a financing lease. I compare it to straight-line depreciation because that's what it is. However, you notice there's never residual. We're just dividing it like we do depreciation entries, right? And over here under an operating lease, though, the amortization is a plug number. It's a number that is done so that your total lease expense is equal to $100,000. And lease expense here is defined by amortization expense and interest expense. So as your interest expense is going down here, what is happening to amortization expense? Yeah, it's going up. But the two of them combined always equals the $100,000. And so the theory behind this is under an operating lease, we're going to make the individual who enters the contract record a liability. But what else are we going to do? we are going to make it so that the financial statement shows an effect, which is the total amount of the payment. That's the whole thing, the whole reason why they're doing all this. They record the right of use asset in an operating lease. That's the proper thing to do. And by the way, the reason why we keep calling it a right of use asset is because it's not our ownership of the asset. We don't own the asset. We're leasing it. So they're using this term right of use so that a reader of the financial statement is not going to say it's our PP&E. It's not our PP&E. We don't own it. We just have the right to use it. So sometimes I say right to use or right of use. It's the same thing. We just have a right to use it for a period of time. It's not our ownership of the asset. Now, if they have $20,000 there in annual payments, you need to understand that the total of the two, the interest expense plus the amortization for every single period of time, needs to equal that, right? That's the concept you need to get across from all of this. Now they're asking us for the balance in the account. Well, this is a tricky thing because what you've got to do if it's an operating lease is then figure out what interest is, and the difference between interest and the $20,000 is going to, of course, be the amount by which the balance in the right of use asset goes down. So here's that calculation. They calculated the interest. Remember to subtract this if there's an upfront payment because you can't have interest on the amount from that very beginning. And the total amount then, these two combined, is going to equal, I believe you can look at these two and see that that's equal to the $20,000. And the amount that reduces your payable, your right of use asset is going to be the amount of the amortization for that first period of time. It could have been, we could have asked you the question, what are the balance not here at the end of the first year, but I could ask you that at the end of the second year. You would be going through and building your table, and you would be adding the two amortizations from first year and second year and subtracting those two from your beginning balance, right? That's the way to work the problems. So this is an important time. I just need to pause and remind you. If we were in a face-to-face situation, I would just drill it down every single meeting. You do a setup. What's the setup for leases? Well, first you go through a dichotomy sort of thing. You figure out, is it an operating or is it a finance lease? Or the other word I use is capital lease. Which one is it? All right? And it only really matters if you're the owner, whether it's one of those or the other one, right? At that initial junction. Because the second step that's so important is you're going to calculate present values and you're going to build your table. Okay? Build a table. So you just run through the steps. Run through the steps and then try to answer the question. And this is my key to having such a good success rate in my students passing the CPA exam. When you get problems, do not jump to the bottom. Don't jump to the balance in the right of use asset. That just perplexes you. It just creates all kind of negativity and your mind can't work. What you do, you lay it out. You say, let's think about this. This is a lease problem. What do I do with a lease problem? The dichotomy, the present value, the amortization table, and then you get into it. Start doing your journal entries, then answer the question. Okay? Or some of you don't even have to do journal entries. You can just look at your amortization table and get there. This is the way to approach the problem. Don't despair. Don't say, I have no idea what's going on here. I don't know what's happening. Drill down, do the setup. And some of you are athletes. Do you just run out there onto the field or onto the court and just go this way and that way? No, you have a plan. You have an approach. You know how to do it. That's what you got to do with these problems. Here we have a leasing of non-specialized machinery. So when they say non-specialized, they are trying to tell you it's not going to meet that last criteria we have when we have the dichotomy decide whether it's a finance or it's an operating lease. Has a 9-year time period, and so you go through the checkpoints. This is a good example for you to review the checkpoints. You're going to need to know those 5 points. You need to be able to give you a problem. You look at the 5 points. You determine how it should be categorized or classified. In this case, you're going to work through that. I'm going to go to the explanation. I would like for you to work through this on your own so that you understand it. Apparently, in this result, this is going to be an operating lease because the solution says the lease expense is equal to the payments. So they work through all of this, and you figure out in the end that none of the criteria are met. So you need to have the ability to tell me how many of the criteria are met. Can you do that? So work through it, figure it out, and in this case they say none of them are met. Therefore, the total amount is going to be an operating lease, and in operating leases, the total lease expense is equal to payments. And this one, they tell you up front it does not meet a financing lease, so you know it's going to be an operating lease. If it's an operating lease, it's important you to go up here. Another thing that's quite important when you work the problem is to figure out who the lessor is and who the lessee. This one is leasing equipment. Mill is leasing. They are the owner. They are the lessor, the O. And then Jim's is the one that is the lessee. So if you don't want to get confused when you're reading a problem and saying who's lessor, who's lessee, note that from the very beginning before you start working through the problem. So here we know it's an operating lease. What can you say about an operating lease? Well, the Jim's records a debit to rent expense for a total amount of the present value. Does that make any sense to anyone at all? Would it be called rent expense? We would never take the total of the present value to rent expense. That you just would never do that. This is the present value. This isn't even the payments. So we're going to discount A. Then you can go through the thing and you can start talking about, for example, here, who should have a lease payable. And the one who has a lease payable should be the one who is the lessee. And yes, it is the lessee here, but if they leased it out, would they record it for the amount of the payment, or would they record it for the amount of the present value of it? So when you work through the problem, you don't really have to go very far into this to start seeing or excluding the ones that just don't make sense at all. And then the correct answer, the only thing we can really say is that the debit is to cash that the lessor gets to record at the very beginning. There's an explanation. I kind of cut it off in this voiceover, but you have the PowerPoints that you can download and look at that. IFRS used to be tested on the CPA exam. Oh, I am so happy it's not on there anymore, and you should be happy too. You should be throwing a party and say no IFRS party, because I mean, during the time of COVID, we can't have these parties or shouldn't be having them, but man, when this came out, wow. If you're a teacher, it means every single chapter there was something about IFRS versus other. In fact, on your final exam in this class, you used to have to learn IFRS, and you don't have to anymore. So this is a moment, right? So skip all slides that have anything to do with IFRS. This is important. There is an exception made to this business about recording things with a lease liability when you're the lessee. That is if it's short term. So if you get it to 12 months or less, it all kind of goes back to what we were doing earlier when we had our liabilities, and we said with liabilities, if it's 12 months or less, you don't have to do present value calculations. So that's the same thing kind of here. If it's 12 months or less, you don't have to do present value calculations. If you don't have to do present value calculations, you don't record a lease liability in a right of use asset. You just call it an expense, and you expense it over a period of time. Now, there's something that goes through all of this I want you to kind of see, and that's that there's an importance to your annual financials, your annual report, and your annual filing with the SEC that is more important, say, than a quarterly filing. And so if that annual report is so important, what we're really looking at is if the annual report is right versus the quarterly report. And when the auditors come in, they're looking at the annual report. They're looking at the annual. Of course, they look at quarterly too, but annual is the big thing, right? So in accounting, the very most important report is the annual report. And whether you have a lease in there and just expense the total amounts that you're paying over a year in the quarters, or in using the present value method, or whether you were to use this shortcut method, in the long run, and you look at the annual report is basically the same. So the point here is also the present value calculation for a short period of time versus a maturity value, which you learned in the beginning. The materiality of the thing leads us to the conclusion that if you have a lease, even though it is, say, a finance lease, there's no real point to the lessee of creating a right of use asset or a lease liability, because the financial situation after a year when the lease expires is going to be the same. So therefore, if you have a lease that to the lessee is going to be a year or less, you don't have to do the present value calculations. You just record your payments basically as expenses. And another thing I like to point out to you is when we've been talking in this lease chapter, you've been seeing that what we are leasing has been things that I call PP&E. They're fixed assets that have some length to them, right? And sometimes they're inventory, though, to the lessor, but to the lessee, when the lessee's looking at it, you're looking at a fixed asset. The implication here is that this lease is a very short-term thing. It's possible that it is a fixed asset, and the fixed asset is just going to be leased out to another party, and they're just leasing the same thing out for 1 year at a time increments. But I think most of your examples, it's going to be a PP&E thing that's going to have a long life. So the fact that it's a short term, it just kind of doesn't really even fit the scenario that you're talking about a PP&E thing, because the useful life of the thing probably is going to be short. All right, so the important thing here is to know we have the shortcut method, and it makes our life so much easier. Here it is. All you do is you just record the payment, basically amount as lease expense. Y'all know accrual accounting, so you know that if you have a lease expense that is going to be $25,000 for a quarter, and your financial statements happen to fall in between a quarter, you're going to have to accrue a lease expense and accrue a lease payable, right? You're going to have to do something there. So that's the only time you really record a liability with these things, and it's just your basic accrual thing. It's not the leases. Also, I should point out at this point that when the lessee does record a lease payable under a typical scenario greater than a year, that typically shows up as a non-current liability, right? And non-current liabilities have current parts of the long-term liability that shows up in the current section. You should remember that from what we had earlier on in the semester. This class, man oh man, it just builds. So if you don't get one chapter, you don't get the next chapter. It's an unfortunate nature of it, but you really have to drill down and study. When can you use a shortcut method? Oh, this is so interesting. This says the first one here has a 6-month term and you can renew for an additional 6 months. So what is the maximum length of time that you would have under that lease? That's really the question you answer. And if you look at A, the maximum is right at 12 months. So 12 months is okay, you can use shortcut for that. If you look at the other ones tend to imply that it could be extended. If it can be extended, then you can't use shortcut. That's the message. Here's the bottom explanation. It says, in order to use a shortcut method, you have to have a lease term including any options to new or extend of 12 months or less. And also, if you have a purchase option, then that implies that it really isn't a temporary type rental situation. It is a long-term commitment that's going to be extending beyond. So therefore, you got to use present value. IFRS, skip it, right? Skip it, IFRS, skip that one. Now, uncertainty. I'm not going to drill down and make you do a lot of problems with uncertainty. The key point here, you adjust the lease term for an option only if it's reasonably certain. So what you're looking at here is, do you think that the lease will extend? And if the lease is thought to extend and you're reasonably certain that it's going to extend, then you need to adjust it. Adjust things. So you do a situation where you look at the lease term and you say, does it look like it's going to be done or not? I don't particularly like this problem. I have to explain it to you. It says the first renewal option can be exercised half of the original and usual rate. And the implication here is that if it says it's going to be so cheap to extend it, that they are going to extend it. So you are going to say reasonably certain because it's just such a good deal. So it's such a good deal, and I say I don't really like the problem because it really has to do with the situation you're in. You have to look at everything situationally. You have to look at Phil Wright Dental Services and say, from their standpoint, does it make sense? Does it make sense for them to do this? And I don't know the financial situation of Phil Wright Dental Service. I don't have a lot of information given on that. But the assumption they're making here is that they're doing fine, they have the ability to do it, and that because it's a good deal, they're going to do it. I don't have all that in front of me. So that's why I don't really like the problem, but they're going to assume it's going to be done, and if it's going to be done, then you have to look at it, and you have to change it, and you have to say, as you say this, reasonably certainly that the original term will be extended to the 8 years from the 5 years. So 5 to 3, they're saying reasonably certain is met. Again, I don't like it because of the way it's done there. Reassessment. So these are contracts. What's a contract? Well, contracts are messy. I mean, you go into it, you sign an agreement, and then the two parties find their situation has changed and it doesn't make economic sense for one of the parties to continue with it. I know a lot about leases, and I can tell you this is very common. So you have an agreement between two parties, and then one party finds out that they really can't use the equipment as long a period of time as they thought they could use it. Their business purpose for this has changed. Or the way they do their operations is such that they found another option that's better. And so they're going to continue with the lease, but they're going to change it. So, or maybe it's such a hot item that's being leased out that the lessor decides that it's not fair, this little amount of rent income I'm getting. I need more. I demand more. And so you have a situation where the parties change their leases. They change the leases. Well, if the it's substance over form, then we need to look at substance over form for this new thing, this new lease that exists, right? So there's an option here. You have a lessee that has an economic incentive to exercise an option that's going to extend or terminate the lease because it's written into the rules of the lease that they can do it. What do you do? What do you do in these situations? Well, you go through. By the end of the third year, the lessee has made significant improvements to the asset whose cost will be covered only if exercising extension, making extension of the lease reasonably certain. So now you go back and you have to remeasure the liability because you're reasonably certain that it changed. You have to go remeasure the liability. So you stop where you are, you do a new present value calculation based on the flow that you expect to be there, and come back with that. So it means your liability is going to change, right? And if the payments change in the lease, then I guess the present value can change from those as well. So they call this reassessment. And another thing that could change is the interest rates. Because it says you have to use the market rates at the time of the reassessment. So what am I going to say about this? When you have this and it looks like really a new lease has happened, you got to go back and you got to adjust that liability on your books. You got to create it to its new value. And here they say the increase in the balance needs to be $150,000 because it affects your right of use asset also. Now you've adjusted your right of use asset. If you're doing straight line, well, that straight line amount's going to change. If you are under an operating lease, well, you've got to work forward on that, and it's also going to affect that because remember your amortization is the difference between the payment and the interest expense for those. Wow. Sometimes the lease changes so much that the 5 criteria that we know no longer apply. You can't go back. This is what they're saying. You're not going to be able to go back to the very beginning and do a restatement of your financials based on the situation as it was when you originally entered the lease, but you're going to stop. You're going to take a pause. You're going to say, well, things have changed so much. Do I still have a finance lease? Or is it an operating lease? That's what you do. You stop, you pause, you basically start the whole process over again. And since you have that lease payable on your books, the first question is, what should the value be in my lease payable now? And if you change the value in your lease payable, you change the value in the right of use asset. So you can read through all this and it just make it as complicated as you want, or you can just know the basic concepts. What I want you to understand here, contract changes, it's substance over form. Look at the thing, look at the 5 criteria, look at the values that should be in your balances, and go from there. That's the approach that needs to be covered. Uncertainty of lease payments. There's a lot of contingencies that can be out there, and what to do if you have these. And here's an example. Mainly it's a lot of disclosure. a lot of disclosure notes associated with leases, and that's the issue. I don't dwell on this business too much here. It's important that you understand these things for CPA exam purposes, and you probably had some of it when you worked through your SMART book, and you might have even had a bit of this on the quiz. However, it's not of as great importance as the other stuff we've covered in these PowerPoints. The description down here tells you we do not consider things that are uncertain except under two conditions. Okay, so the other things we were saying, we were calling it reasonably certain. We were using the term reasonably certain. That's what I want you to get at. Reasonably certain. Then you make the adjustment. If it's uncertain, then it can't be reasonably certain, right? Changing the terms of the lease, as I was talking about before. Anything that changes there, you may have to reclassify, you may have to change it because it's substance over form. Look at the substance of the thing. Is it an operating, is it a finance lease? If we had it as one and it becomes the other, you don't go back and rechange what you've done in the past. You just say, stop, where am I? What should my liability be on my financial statement? And the counter to that, of course, is changing your right of use asset. Here we changed it. This is a complicated problem. I just want you to see the parties here agreeing to extend the lease and increase the 3 payments in their amount, and they also have a difference which affected us in our interest rates. Go through it. Make sure you understand that now with your modified lease, you find that your present value has changed. It changed dramatically. And because it changes, you have to increase the balance here by this amount because your present value calculation is now different. Now, the other one I said reasonably certain. This one, they have actually signed a document which changes things. And I would, from this standpoint, I'd say it's like looking at it, as I said previously, and saying, got a totally new lease here. It might be the same equipment leased, but we signed a new agreement in effect. And to do that, you got to go back, look at it, figure it out. Notice here even the classification. It was an operating lease before. Now it becomes a finance or sales type lease. Under these two criteria, and it was an operating lease, the lessee, of course, would have recorded that lease payable, but the lease payable now is going to be this. The lessor or the owner would have never received or recorded a lease receivable, right? But under this, now the owner who's leasing it out is going to record a lease receivable because it is a finance sales type lease. So you've got some journal entries that are done here, and with the owner here, they are recording an amount. It's also going to affect them for their accumulated depreciation and how they start things out here. Not so important you understand this bit. I want you to understand this bit. IFRS skip. Residual value. Residual value, the only thing you need to understand here is it's guaranteed. And it's guaranteed by the renter. So if the renter says at the end, I guarantee that you're going to have a value here with this equipment at the end. What does residual value do? It says that the person who's renting the thing is going to bring it back in good condition. And I think this really makes sense. If you were the lessor renting something out, you wouldn't want the party that's renting your thing to trash it out, bring you back something you can't lease out again. So it depends on what your whole transaction is based on. If you're the renter, you're renting it out. Are you going to plan on renting this out again After that lease period, are you going to rent it to someone else? If you're going to rent it to someone else, you want it to have some value. So you build it into the contract. Contract says you got to guarantee they'll have this value. If it doesn't have the value, then wow, you're going to have to pay me. You are going to have to pay me that value because that's what I've lost because you trashed it. So that's the benefits. You see them listed there. So again, don't just say residual value, it should say guaranteed residual value. And a guaranteed residual value and a bargain purchase option problem is essentially the same problem. So that's the shortcut for me for you to understand this. What you need to do is you need to take the present value of the residual value. And that's a PV of 1, and that's 60,000. When you do your calculations, you have a total amount of present value that you need to receive, and that total amount of present value has to include the PV of the residual plus the PV of the payments. So there's two components there of it. They reverse engineered this problem. They know they want to get 479,079 out of it. And they know that there's a PV of 1 calculation, which is this amount. So therefore, they want this present value amount to be showing up in their annuity payments. And so they do a PV of an annuity and get this table number here divided by this total PV. That's after taking out the PV of 1 for that, and they come up with their payments. If I were in class with you, I'd say, let's do this differently. Let's take this amount and say, what is the present value of a stream over 6 years at the beginning of each period of time? What's the value of that? You'd say this amount. And then you'd say, well, what's the present value of the 60,000 at 1? It's this amount. So I guess if I add this amount to this amount, that should be my total present value calculation, shouldn't it? So it's a little confusing the way the textbook does it, the way this example is laid out, but understand there's two present value streams. There's a present value of the residual, which is guaranteed, and the present value of those annuity payments. And if you built the table, you discover as you go through here that actually when you do that and you record this, you notice what they have here is a 60,000 that's being shown here. That is a guaranteed residual value. And I don't like it that you're saying it's in the cash column. What you're saying is you're guaranteeing this residual value, and if this residual is not there, they would pay the cash. Okay, so at the end of the lease term, the equipment here of the lease receivable had this amount here. It needs to go way off of the owner's books, and the value of the equipment, which is coming back, is 60,000. If it's not worth 60,000, they are going to record a debit to cash for the amount of the difference, and then they're going to put the equipment on at whatever its value is. This is the owner. This is the owner. And so even though they rent it under a lease, at the very end of a lease, if the property does not transfer, then what you see under a finance lease is that the equipment needs to come back on the books and it'll get depreciated. A purchase option should be handled basically the same way as you handle residual. I'll let you read through all of this, but for purposes of working through a problem, if you have a purchase option, it becomes a finance or a capital lease, I sometimes call it. It's a finance lease. That's what it is. And now the problem here with the purchase option that makes it a little interesting, we used to call these bargain purchase options. If it looks reasonably certain that they're going to use the option, and generally the criteria is it looks like a good deal, If it's a purchase option and you buy something at 50% of its value, you're going to do it and then sell it to somebody else and make that 50%, right? So a purchase option, if it looks like a good deal, you're gonna say it is a bargain purchase option, which means you need to do the PV of 1 from that option date when it can be exercised. So to go back with this, instead of getting the equipment back, what's going to happen here, this is the only real difference here, is between it and the guaranteed residual, is we're going to get cash in because that equipment that we already took off our books. Remember from the beginning when we had this finance lease and with a lessor, we recorded it as a lease receivable. We transferred it from being equipment to a lease receivable in the beginning. Well, we don't put the equipment back on our books because the lessee has taken it. They have it. It's theirs. But we get cash. We get cash. And so we record the cash coming in. Now, initial direct costs. What about the cost that are important here to going through this? You got legal costs. You got all that, and all these things that can actually happen here. If it's the lessee who is having those costs, remember any cost associated with a use of an asset that is necessary should be added to the asset, right? So that's back to that basic concept you learned. So it's nothing really new here. If it's a cost that's necessary associated with an asset, you add it to an asset. In this case, it's right of use asset. So what happens with these? They're going to be amortized, aren't they? Now, if it is a sales type lease and it includes selling profit, so it's an inventory item that the lessor is selling. If it's an inventory item that is being sold, then you consider this thing as including selling profit, and the costs need to be expensed in the period of the sale. Okay? If it's not associated with selling a product, you take it over the lease term. And in operating lease, it goes over the lease term. So it depends on whether you're selling something, it's an item of your inventory or not, how it goes off your books. Leasehold improvements are changes to the property by the lessee. And if you no longer have a right over at the end of the time period, this is like if you're renting land and you put bushes on it. So you put some bushes on your land, okay? Bushes have a life, and if the property is expected to go back at the end of the lease, then you depreciate it over that period of time. If it doesn't look like it's going to go back and it's going to be a transfer of ownership, then you use the useful life. And this is something else we had earlier when we talked about the right of use asset itself. Okay, leasehold improvements, just a basic concept question there. Generally depreciated over the useful life, and we can say that it is depreciated over its useful life in a situation where the lease is continuing. That's what I'll say about it. Statement of cash flow, generally where you see these things under operating, if it's an operating lease, it shows up under operating activities. If it's a finance lease, you need to look at it and figure out where it goes. These are just little tidbits of information here. Disclosures are extensive with leases. That's what I'll just say. This is a question about that. And this is a sales type lease. The lessor reports cash receipts as a part of their operating activities. Salebacks. There's a whole appendix about this. And lease salebacks are actually quite common. And my point in all this is if you really do not have a transfer of ownership in the thing, it's not really a financing arrangement. There's nothing in substance that looks like it's a capital lease. You're going to say that you cannot use the sale leaseback approach because it is this is only allowed if it is an operating lease. Is it an operating lease or is it not an operating lease? So people play around with things and they try to they sell things to sell something to someone else and then they lease it from them. So they're taking something off their books and trying to play around with their financials. The whole point in the sale leasebacks that's covered in the appendix, I'm not going to cover it extensively or probably not even at all on the exam. I'm not sure. It won't be extensive. Is that you can't play around with your financials. That's the whole point in Appendix 15. Here's an example. They need cash, so they sell their warehouses and then they lease back the warehouses. Well, selling them will give them the cash in and it'll look like they have a gain on their financials, but they still have an obligation, don't they, to lease them? They still have a liability created. So in effect, what they've done with this thing is they're trying to make it look like off-balance sheet financing. And off-balance sheet financing is frowned upon by in GAAP now and led to a financial crisis, a big deal, right? So this whole example is the reason why we do these rules is we want to make it so that they can't cover up their true financial situation. So the whole thing here, they take it off, they get cash, they have a gain on it, but look what happens here. They have to still record a liability, right? They still get the liability. They can record the gain, but you still have to record the liability. Only time you really get to do anything like this is again when you have an example and it is an operating lease. Since it's an operating lease, amortization plus interest expense has to equal the payment. That's that. This one is an example of where it does not qualify for sale leaseback accounting because in this situation it is a not an operating lease. It has to be accounted for as a finance lease. Instead, it's not an operating lease. So if it isn't, then you do not have a situation where you get to record any gain at all on that situation. A leasing back example here. Again, these examples here may be important for you when you study for the CPA exam. I'm going to not emphasize these very much at all on your exam. You may see something on it, but it's not going to be consequential to you and your exam results. So lease expense and lease revenue. The lessee has two related expense, interest expense and amortization expense, and this is the two rent expenses. They combine to equal an amount. And these two need to add up again to the amount of the payment if you're under an operating lease. In a financing lease, you calculate these two. They are in no way related, and they actually even show up in separate parts of the income statement because this is interest expense and this is a part of the amortization, just like depreciation. So if you're an operating lease, you combine the two and call it lease expense, and that's what way it shows up on your financial statement. If you're under a financing arrangement, then you consider this a part of your total costs of borrowing, which is interest expense, and you show this as you would at the sort of a depreciation type item. Bargain purchase option, you need to do the PV of 1 on those just as you would guaranteed residual value. Now, here's the little trick. I said there was a trick with bargain purchase option. If you have a bargain purchase option, and a bargain purchase option is a purchase option that you expect to be exercised. If it's exercised, then ownership transfers. Would the lessee continue to make lease payments if they own the property? No, they'd be a fool to do that. So if you have an arrangement here, and if you want, you can buy the thing after 5 years, or you can continue to rent it for 10. Well, okay. I think it's going to be in my benefit to buy the thing at 5 years. When you do your present value calculation, you're going to ignore the payments after 5 years because you're not going to make them. You are not going to make them, because when you look at the substance of the rental agreement, substance over form, you're going to buy it at 5 years. So when you do your annuity calculation and your present value calculation, exclude those extra 5 years. Reasonably assured. We like this word reasonably. Reasonably certain. Reasonably assured. Has the option to purchase it at the end. If the option to purchase it comes at the end, it's a PV of 1 from the end. You use a PV of 1 table, figure out how much that is. And again, I'm going to say this is kind of backwards, because what we are saying is the total amount, this one I guess is the right way. The total amount you're going to recover is this. You're going to recover a cash payment at the end of $60,000, which has a present value of this, and then you're also going to recover these amounts of $92,931 in periodic payments that they're going to pay you. So the total present value that you're going to get in is going to be $479,079. This is equipment which was manufactured. How do you handle manufactured equipment? I don't know. The point here is that the present value calculation needs to go into here, and if you're doing it this way and subtracting it, it's confusing again, because what we're saying is this is a PV of the annuity, this is a PV of 1 for the BPO. If this had been residual value, you've done it exactly the same way. It'd be $60,000. The present value of the $60,000 guaranteed residual value would be this. You'd add the two together and you record the lease receivable or lease payable for that amount. When you work through it, it should look very much like the guaranteed residual value. That's why I say don't make this any more difficult than it has to be. Now, what I want to tell you here is, what if this $60,000 bargain purchase option came up here? It happens right here. Then what do you say? This is 0, this is 0, right? And in fact, the lease will end right here because they bought it. They bought it up here. So when you calculate this amount up here, the present value calculation needs to look at it and say, well, right here we're going to pay $60,000. So then you would have the present value of these things and the PV of 1 for $60,000 to calculate that. That's what I'm getting at. The bargain purchase option doesn't come at the end, but comes up here somewhere. This is a common trick question on CPA exams. Then what you need to do is you need to calculate this based on the streams, assuming that it's purchased at this date. If it's purchased at this date, that fool is not going to continue to make $92,931 in payments every year. They're going to say, I own it. I don't have to pay anymore, right? So that's the deal there. Okay, So if you buy it, you're going to have to depreciate it, right? If you buy it, you're going to depreciate it. You're going to continue depreciating it. And the owner is going to take the cash in, and they are going to then take off the lease receivable, record the revenue. Doesn't this look just an awful lot here like the residual business? Except with the guaranteed residual, they'll be putting the equipment on their books at that value. Here's the point I'm making. It reduces the lease term. And it's tended to be the worth of the asset at the end of a lease term, and that's what they do. It reduces risk to the lessor, and it's an additional lease payment. There's some more in here, which this is with the same thing with the guaranteed residual value and versus a BPO. You get the same, almost the same results. Certainly your calculation here on present values is going to be the same, so your initial recording is going to be the same. It's just that when you get down to the end of the thing and you start looking at it, if they have a bargain purchase option, the situation is a little different at the end, because if they're purchasing it, they're going to have the asset. The rules about modifications and uncertainty I discussed previously, so we're at the very